The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in New York, I'm Katie Greifeld. Kicking you off to closing bell here in the U.S., Romain Bostic will be joining me shortly, I promise. But until then, let's check these markets really taking a hit to sentiment right now. Of course, we have a pair of troubles when it comes to the regional banking landscape. We'll get to that, but just know that it's sinking the S&P 500 by about 0.7%, even taking away some of the enthusiasm that we've been seeing around AI. The Nasdaq 100 off by about 0.5%. Meanwhile, sending a big bid into the bond market. The 10-year Treasury yield down about 5 basis points. You're seeing something similar when it comes to the 2-year as well. And then you take a look at the VIX. We're knocking on the door of 24 for the market's fear measure. We'll, of course, continue to monitor that. But as I mentioned, we may be seeing cockroaches coming out of the woodwork, as JP Morgan's Jamie Dimon warned. An earlier advance fueled by another solid outlook for AI demand, now taking a turn for the worse. Yet another day this week where the S&P 500 has played both sides of that flat line. Now, the fragility of the $28 trillion bull market showing signs of exhaustion, causing bonds to rise and gold to rise as well. Now, the news that shattered the rally, regional lenders, Zions Bancorp and Western Alliance, disclosing problems with loans involving allegations of fraud, adding to concern that more cracks are emerging in borrowers' creditworthiness and plunging the KRE ETF. Now, all of this is happening as we're anticipating a major announcement from the White House relatively soon. Now, while that specific announcement may not touch on geopolitical issues, that is one topic that traders have been watching closely. Citigroup strategists saying the equity bull market could be headed for a choppier phase, particularly with U.S.-China trade tensions back on the table and a path to resolution looking more and more complex. Let's kick things off now with Sinead Colton-Grant. She is Chief Investment Officer at BNY Wealth. Sinead, great to see you in person.
Great to be here, Katie.
Let's start with what is the bugaboo for markets at this moment. And that, of course, is what we're seeing in the regional banking environment. We know that we had some scares when it comes to Tricolor, when it comes to First Brand. And I feel like that is one of the reasons why you're seeing such a strong reaction in markets right now.
Well, I think it's a couple of things. First of all, credit spreads in public markets have been really tight, and we know there's been such a big interest in private credit. There has been a concern that maybe things are too good to be true, right? What are we waiting for? With the news last week and then again this morning, you're seeing evidence that perhaps underwriting standards may not have been as robust as they should have been, that when there's such a flood of capital going into one space, that the competition to deploy that capital becomes a lot tighter. But this is where we think the ability of individual private credit managers to source their own deals rather than necessarily competing broadly is really, really important. And if you're thinking about this from a broader private credit standard, which is what we talk to our clients about all the time, it's manager selection is critical. Understand how and where they're doing the deals. But look, with regional banks, we're a couple of years on from the SVB crisis. There's a concern about how and where are they generating those additional returns and additional profits now? Have they been taking a little bit too much risk again?
Sinead, there's so much to dig into there. I want to start with the fact that, you know, when it comes to private credit, it just feels like so many people have piled into that space. And as you mentioned, they're competing for deals here. And one of the concerns was that there's just not enough deployment opportunities. So I guess that is, as you referenced, sort of the big fear hanging over the space, that there's going to be additional shoes to drop here, even if they're not all connected, these separate issues.
Well, and let's think about underwriting standards for a moment, right? If you have the ability to really dig in, if you have a team that knows that industry and market very well, that puts you at an advantage. But also think about the broader landscape, right? Many of the big private credit offerings are aligned with firms that also do private equity, that they do other things in this space. So how they compete for deals is a little different than someone that's just trying to underwrite a loan in isolation.
Yeah, that's fair enough. Sort of the pure play players here might be struggling a little bit. I want to broaden out, though, and talk about the broader equity market, which, of course, we're seeing risk appetite take a hit today. We know that the government is still shut down. We're still not getting economic data. We are getting corporate earnings. So far, it's only been the big banks. But when you take a look at the sea of companies yet to report, what's your expectation as to whether corporate America can live up to the expectations priced into valuations right now?
Well, we're pretty constructive. We're expecting a strong earnings season, and actually we think that the full year is going to close out pretty strong, with earnings expanding about 11% or so. And actually continuing on in 26, we expect earnings to expand about 13% over 2026. But look, I want to link this to private credit as well, because, you know, we need to talk about the consumer in all of this. We've had a relatively muted impact from tariffs across the board, but what we're watching really closely is the impact of the elimination of the $800 de minimis exemption, because that's where you really get smaller ticket items, where people are now seeing the impact of tariffs, and also the fees that the delivery companies will charge for navigating the tariffs. But the consumer is key here, right? And so we know that household wealth has expanded by 57 trillion over the last, call it 5 years. Leverage levels are at their lowest level in 50 years. Part of that is just the math, right? If the assets go up and the liabilities are relatively unchanged. But that is dominated by the top 10% of consumers.
Right.
When we look at the bottom 90%, which is a crazy way to phrase it, but let's call it the rest of the consumer base, they're feeling the pressure of cumulative inflation, of wages that, you know, they did okay in the first couple of years of the 20s, but have not kept pace more recently. And you're starting to see an increase in auto loan delinquencies, credit card delinquencies. They're up at about 12%. And as we look at the bank earnings, you know, some banks were referencing increased delinquencies there too. So linking that back to private credit, you know, that's where you start to see some of the stresses come through and the ripple effect. But with equities, we're constructive. We think, you know, you've got to remember, if you're going to generate return, you have to take a little bit of risk, and we're seeing some volatility today.
All right, so public listed equities, still constructive there. Sinead, have to leave it there. Great to kick off the show with you. That is Sinead Colton Grant. She is Chief Investment Officer at BNY Wealth. Meanwhile, let's talk more specifically about what's going on with those regional banks, because as we mentioned, you take a look at shares of Zions, of Western Alliance, plunging the entire financial sector right now after both banks disclosed problems with loans involving alleged fraud. Zions revealing a $50 million charge-off for a loan underwritten by its wholly owned subsidiary, California Bank and Trust, while Western Alliance saying it's dealing with a borrower that failed, quote, to provide collateral loans in first position. Here to break it down further is Herman Chan. He is senior analyst of U.S. regional banks over at Bloomberg Intelligence. So, Herman, I mean, you see the reaction in markets right now. The entire sector plunging, the S&P 500 falling right along with it. Put this in context. What we've learned so far, does it justify some of the nervousness that is really on display?
Look, Zions yesterday after the close reported about a $50 million charge. So the market cap change today across the banking space vastly outdwarfs this credit charge that Zions is taking. What the market's really looking at is, as Sinead mentioned earlier, credit underwriting, controls within the banks, who they're lending to, client selection, and specifically the lending to non-bank financial institutions. So the loan in question for Zions and Western Alliance is a non-bank loan. This is sort of what we've seen across the linkage with Tricolor as well, where banks are taking a bit more credit risk with non-bank lending. And so now there's questions, is this really safe for the industry? And trying to parse through what is inside the non-bank credit within the banking system itself.
And just to make sure I'm understanding you, so are you saying, you know, when it comes to non-bank lending, that basically they're competing with those lenders and that might have pushed them further out the risk spectrum?
They're lending to the non-bank lenders. Okay. So there is derivative risk when the non-bank lender is creating fraud or there's issues with the underlying collateral, which we're seeing with this Cantor loan and also with Tricolor as well.
So you take a look at how this is being expressed in KRE. This is, of course, an ETF that tracks all of the regionals. Up at the top, at the bottom, you see Zions and Western Alliance dragging down the ETF. There's only one name that is higher today. That's Triumph. So really, you have 147 regional banks that are lower right now. Are there any specific names we should be keeping an eye on in terms of what might be a shoe to drop next?
Yeah. The issue is that when there's instances of fraud, it's really hard to decipher from my seat as a bank analyst, right? We're looking at the credit trends within the balance sheets, and it's hard to really suss through what's really going on. So this is what's really creating a lot of anxiety in the markets today, because there's really a lot of unknowns, and it's more pervasive. We've seen fraud at 3 companies now, and is there more to come? That's really the question that the market's trying to suss out.
All right, Herman, great to get some context with you. Of course, we'll be following this story closely. I have to imagine we'll be speaking again soon. That is Herman Chan. He is senior analyst of U.S. regional banks at Bloomberg Intelligence. Let's turn our attention from the U.S. economy over to Europe. The head of the IMF applauding Germany and Canada for maintaining better fiscal shape than their G7 peers earlier today. Now, this as Germany's economy struggles to break out of stagnation mode, though the Bundesbank has said it sees potential green shoots once we're through the third quarter. I'm pleased to say we're joined now live by Bloomberg surveillance co-host Lisa Abramowitz down in Washington with the Bundesbank president.
Thank you so much, Katie. I am here with the Bundesbank President Joachim Nagel. And Joachim, there has been this discussion before we get into just how you balance the risks of inflation and growth. I do want to get a sense of what Katie was just talking about, financial stability and risks there. How much have credit cracks or concerns about elevated valuations dominated the conversations you've had here?
Yeah, thank you very much for this question. I think it is an issue here. It's part of our discussion. As always, financial stability is part of our mandate because it has so many spillovers to price stability. And we all know there are so many uncertainties. Is it the tariff discussion? Is it geopolitical risk? Or is it the situation with China? Many uncertainties. So we have to be concerned to a certain extent. It doesn't look too bad for the moment. But I guess we have to be vigilant, as always.
There is this discussion among a number of ECB members that you're in a good place, that 2% after 8 rate cuts has been a proper place to be. At the same time that there is this potential downside risk to growth, does it concern you that there isn't a rate cut on the table, considering that inflation seems to be in a good place and there still are downside growth risks?
The most important element here is what do we know about price stability and how are the prices are going for the next couple of months. As far as I can see it, I'm pretty confident that we are close to our target, and this is good news. So I'm not so concerned that maybe we might undershoot inflation for a long time. So personally, I think this meeting-to-meeting approach is the best way to really do the right thing. So I'm rather comfortable where we are. And when there is maybe new data coming that gives me maybe a different opinion, I'm open to change something. But for the moment, I would say it's good where we are.
How much are you focused on China and the exports from China coming into the region and what that could do in terms of a disinflationary force right now?
Well, this is a difficult situation. Maybe it's too early to say something about the medium-term and the long-term impact. Is that a situation that will last for long? But the whole tariff situation is definitely not a situation where we will see winners. It's a lose-lose situation. But we on the European side, we have to look at it. This is for sure. We have to talk to China. I think China has to understand that they cannot flood Europe with cheap goods. I think this is not something that I would accept as a proper strategy.
So it's not necessarily a disinflation that you would welcome?
Well, at the moment, I do not see this development that we see really prices might go down in a way that I would take that from a central bank perspective as a kind of a threat. So I'm vigilant. I'm definitely not in the position to be complacent. We have to look at it. What does that mean for the prices in Europe? But I guess we have also to talk to China.
There's also a big discussion here about the technological disruption and artificial intelligence and what this might do to reconstructing the economy in different ways. How much are you seeing it as as AI being a disinflationary versus an inflationary force? Which is it?
This AI topic is a hot topic, I think, and I believe it will be one of the hot topics for the next years. It is a disruptive technology, this is for sure. We do not know what does that mean in terms of productivity gains, what does that mean for employment, what does that mean for inflation. So it's maybe, again, maybe we do not have enough information. It is too early, we have to look at it, but it will come with challenges.
It seems like it's trade, AI, and then dollar debasement. Those to me are like the three big issues. And dollar debasement is also part and parcel with the crypto discussion and how much stable coins are going to disrupt the financial system. I'm wondering, from your perspective, do you take that seriously in terms of how much people are moving away from the dollar as reserve currency, or do you think that's just a popular topic?
I guess we do have to take that serious. I think this is an important development. I think stablecoins on its own, at the moment, it's not a relevant asset class, but we all know that over the next years it will become much more relevant. So from a regulatory point of view, we have to understand better where are the dangers behind stablecoins. Is it maybe something that means dollarization? So from the European perspective, this is something we have to look at it. But on the other hand, we should be also open to such innovations. But as always, there are pros and cons, and the role of the central banks is to find a good balance between the positive aspects and the negative aspects.
So as the head of Germany's central bank, how much do you almost wish that there was a dual mandate at a time when there is an auto sector that's flat on its back, that's really struggling? The economy hasn't really been growing significantly, if at all. Is there a sense that maybe there needs to be more done to try to support growth from the monetary side as well as the fiscal side?
So this is easy to answer. I'm very happy with the single mandate. I'm not looking for more. I think this is enough. And we have really a lot to do the last 3 years, coming from a period with very high inflation rates, now again down to 2%. This was a tough road, and single mandate, this is okay.
President Nagel, thank you so much for your time. Really appreciate it.
Thank you very much.
That was the Bundesbank President Joachim Nagel, and I'll send it back to you, Katie.
All right, our thanks to Bloomberg surveillance co-host Lisa Abramowitz, as well as the president of the Bundesbank. Now coming up, the KBW Bank Index sinking. Up next, we'll take a closer look at the sector with an analyst who covers the space. This is The Close on Bloomberg. Welcome back to The Close. It's time now for top calls. A look at some of the big movers on the back of analyst recommendations. And we start with Lithium Americas. JP Morgan downgrading to underweight and setting a price target of $5. The analyst views the U.S. government deal as a downside protection versus a strategic move and says the stock could face a correction after rallying 200% on the news of that government stake. Shares down 21%. Next in line, Lululemon. Bernstein souring on the athletic retailer as they cut to market perform and slash their price target to $190 from $220. Quote, we were optimistic of a 2025 U.S. product-driven recovery, but it hasn't worked, notes the analyst. Shares down about 2%. And finally, we have Las Vegas Sands. JP Morgan is betting big on the casino and resort company with an upgrade to overweight and a raise on their price target to $60 from $56. The firm sees upside from LVS's Singapore exposure and believes it could push earnings higher. Shares right now, though, a little changed. Those are some of our top calls. Now, of course, we're also keeping a close eye on the banking sector. U.S. Bancorp and Schwab are just two of the latest to report earnings in the space, following the lead of the big banks earlier this week. Here to discuss is Ken Leon. He is Director of Equity Research covering U.S. global banks sector over at CFRA. Ken, it's great to have you with us. It's a busy day for the banking sector, maybe not because of earnings, but let's start there. Of course, we have the big guys out of the way and some of the medium-sized guys as well. Who sticks out to you when you take a look at the top 5 banks in the U.S. as really putting up the best numbers and surprising in a good way here.
Yeah, and our theme really going back to the summer was, can these banks earn their valuations, their performance outperforming the S&P 500? And clearly the delta for strong performance was the capital markets. Goldman Sachs and Morgan Stanley stand out the best. But we did see, even across all the other businesses for these large banks, very good performance from Bank of America, which we did upgrade from hold to buy, Citigroup, and of course, JP Morgan Chase. So overall, if you're an analyst, you can check all the boxes in terms of driving strong revenue and earnings beat. But also, it's interesting, there was no major increase in the reserve build for loan losses. Actually, some of them have gone down. So again, with the market volatility, which we'll talk about today, and the other banks, or I cover the alternative asset managers, what is going on? Because these large banks did extraordinarily well.
Well, let's go exactly there, Ken, because, of course, we're seeing a bit of a moment when it comes to the regionals. We know how that started, of course, with Zions and Western Alliance today. That's bleeding into the performance of the big banks. When you take a look at the KBW Bank Index, I believe down about 4% right now. I want to loop in the alt as well, but talk to us about why we're seeing what seems to be isolation to some of the regionals, two specific names, really take down some of the bigger banks in such a dramatic fashion today.
Well, we need to do that. And it comes to credit risk. And is there any black swan event or a systemic risk with any major industry on the commercial loan book? I think the answer is no, and it hasn't been for over 2 years. So then it gets into, how aggressive they may be on either smaller business or consumer, or in different credit quality levels of consumer, as the smaller banks do offer more active lending to lower FICO scores for households. Well, this came about over a week ago with auto loans. We did, of course, see some issues even related to private credit, which is another area. So at this point, I think myself and all the bank analysts who don't cover the smaller banks are trying to see that all boats don't rise in the water, and there might be some separation here between Main Street and global markets.
Yeah, no, it's a fair point. Let's talk about, of course, the linkages more directly to private credit. You saw Jamie Dimon and Mark Lipschultz sort of trading barbs about who has the most cockroaches. Really coming back to what you mentioned, those pair of auto lenders last week when it comes to First Brands, when it comes to Tricolor, and who exactly is to blame. But you take a look at the chart right now, you take a look at some of these alternative asset managers, Blue Owl, Apollo, Blackstone, their stocks are all underwater for the year at the same time that you have JP Morgan close to record highs. What does this say about how Wall Street is judging some of the different portfolios and some of the loans that these guys have on the books?
Yeah, I feel their pain because I have buys on these stocks. In my 40 plus years, these are some of the smartest managements. Private credit, when you hear the starting with Blackstone next week and thereafter all the others, Apollo, Ares, Blue Owl, what they'll talk about is most of their book for private credit, which runs a variety of different markets and products, is investment grade. There's careful due diligence on direct lending. There's asset-backed securities. I don't see here a systemic risk or a black swan event as we had with Credit Suisse going back over a year ago. So I'm scratching my head. I think these firms are going to come back and kind of refute Jamie Dimon. And of course, Blue Owl was the first one to do it. But you get people like Mark Rowan and others, out to the investment community. It's going to be a very interesting 5 to 10 days.
Yeah, absolutely. Between, of course, those alternative asset managers and more of the regional banks stepping the earnings line, definitely a lot to look forward to there. Ken, really great to get some time with you on such a busy day. That is Ken Leon. He is Director of Equity Research over at CFRA. take a quick check at these markets right now. As we mentioned, sharply lower when it comes to the banks. That is bleeding through into the S&P 500, down by about 0.7%. And even, of course, some of those big tech names getting affected as well. Now, coming up, we'll speak to the IMF's former chief economist about the state of global markets and her warning to U.S. investors. That conversation coming up next. This is The Close on Bloomberg. It's just about 3:30 p.m. in New York. This is the countdown to the close. I'm Katie Greifeld, and finally, sitting to my right, the man himself.
Yeah, thanks for holding off on starting the show here as we kick you off to the close. It's just an hour and a half to go now, Katie, until those closing bells.
Well, actually, just 30 minutes.
30 minutes to go.
You go out to California, you lose all sense of time. Just 30 minutes.
I shouldn't have bought this Seiko.
Until the close.
Yeah.
It's an ugly one,
Yeah.
so we'll see if something amazing changes in the next 30 minutes. But our next guest actually is sounding the warning bell on the U.S. stock market, writing that the current rally around AI may be setting the stage for another painful market correction, drawing the comparison to the dot-com crash of 2000. Gita Gopinath joins us now. She is a professor of economics at Harvard University and, of course, the former chief economist over at the International Monetary Fund. Gita, great to have you with us. So the basis of your argument, as I understand it, is that you take a look at the investor base in U.S. markets, and it's very over-concentrated at this moment in time.
What I point out, Katie, and it's a pleasure to join you, which is that if you look at the amount of wealth that is now invested in U.S. equity, this is U.S. stock markets, these are at record levels. It's not just U.S. households that have very high levels of exposure, but if you look at foreign investors, they've never been more exposed to U.S. equity. And so we are seeing a very sharp increase in the stock market. Of course, you'll be seeing these bumps day in and day out, but the levels are at record highs. And I'm not saying that we're now on the verge of a bubble bursting. That's just impossible to say. But I think there are reasons we might expect a correction. And so the big question is what happens if we do have a correction like the dot-com bust? And the consequences of that could be much more severe and much more global than it was in 2000 and 2001. I mean, that's the point I was trying to make in that piece.
And it's interesting, of course, to read this argument and hear you explain it, because this year you think about what's happened. You've had a lot of outperformance when it comes to Europe. Europe's still outperforming its stock market versus the U.S. And still, at least in your view, that hasn't necessarily changed this overconcentration problem. When you think about European investors choosing to go and invest heavily in U.S. markets versus staying at home, so to speak.
We are certainly seeing signs of some diversification, but I think overwhelmingly it remains the case that the U.S. stock market is where you have the most dynamic tech stocks. AI-driven growth is most promising, and so it's hard to miss out on that. So I think the fear of missing out keeps a lot of global money in U.S. equity markets. So there's a good reason why they're in there. This is not necessarily all a bubble. But the point is that we've never had that high a level of exposure to U.S. equities, which means unlike 2000 and the dot-com crash, this time the effects of any correction in the markets would be more severe. Many more countries would be impacted. Consumption would be more harder hit. And we are already at levels of growth of about 2%. I mean, before the dot-com, U.S. growth was over 4%. So we are not exactly at very high levels of growth at this moment. So any of these shocks could generate a big turn in markets and in the economy.
Gita, do you actually see any potential, though, that we might actually see a bit more broadening, geographically speaking, of these investments? The idea that I think everyone recognizes the asymmetry that you're talking about. But at least earlier this year, there was a lot of talk, primarily because of some of the policy positions and uncertainty here in the United States. People were looking for viable alternatives, or at least complements, to U.S.-based investment.
In April this year, I think that was the moment when you had the Liberation Day tariffs that were announced, and stock markets adjusted by a lot because there was so much uncertainty about where things would go. And there were indeed many investors that looked around and said, okay, can we have this level of exposure to U.S. markets? Can we rely on the dollar always strengthening as it has over the last 15 years? And you absolutely see adjustments now. there is a lot more hedging against dollar risk. You see more capital going to emerging markets, I think to a great extent because the dollar has been weakening relative to those currencies. But if you step back and ask yourself, where is growth going to be better, in which parts of the world? We just had the recent IMF World Economic Outlook report come out. And again, in the G7, the US has the strongest growth projections. And for many emerging and developing countries, if you look at China, growth does not look that promising. Yeah. So I think there needs to be more balanced growth around the world than what we've seen over the last decade.
With regards to the growth in the U.S., as you know, Gita, there's been a lot of disruptions in sort of our institutions here in the United States, maybe for the better, maybe for the worse. But there's no doubt about it that whatever growth we have, it's also being accompanied by a growth in debt, a growth in deficit, a growth in share of GDP that is now bordering on the unprecedented. And I am curious if this is just a problem for the United States to deal with on its own, or is this a problem for the world as a whole?
As we know over and over again, anything that's a problem for the U.S. to deal with is a problem for the world. Because whenever you have any correction in the U.S., be it in bond markets, be it in the stock market, it spills over to the rest of the world. So the U.S. is never alone in this. I do believe that bond markets are also in a situation, not in the U.S., but if you see in the U.K., you see in France, where you're seeing much more volatility in bond yields than we've seen in many years. So there are big question marks around government's ability to continue to borrow at the levels that they've been doing. The U.S. yields are not bad, I mean, given the high levels of debt that exist. But what you have to look out on the horizon is this ever-increasing levels of debt to GDP. And we are in a very different environment compared to the late 1990s. We have tariff shocks, we have tariff uncertainty, we have questions on central bank independence. I think if any of this plays out, it could trigger multiple markets going into risky territory.
All right, Gita, we have to leave it there. Really appreciate you taking time for us. Gita Gopinath over at Harvard University, former chief economist over at the IMF. When we come back, a focus on commodities, a focus on gold, pushing to new records. We're going to catch up in a second. But Kopernik Global Investors co-CIO, Alissa Corcoran. Stick with us. This is The Close on Bloomberg. Gold has been on a tear this year, record after record, now on pace for its first 10-week winning streak in 45 years. Our next guest says, though, it may be time to shift focus to other parts of the commodities space. Alissa Corcoran joins us right now, the co-CIO over at Kopernik Global Investors. And I guess, Alissa, the question is, where do you shift right now? I feel like valuations are also pretty high elsewhere.
It's true. It's hard to find an area that hasn't actually performed well this year. So gold miners still, I think, have a lot of upside, but we've been trimming. I mean, we had 20% of our fund in gold miners at the beginning of the year. Now we have 8%. And where we redeploying that capital is really into other commodities such as copper, iron ore, manganese, nickel. I mean, oil, all of these commodities versus gold are extremely depressed.
I am curious, though, what's the difference? Because I feel like people are in gold primarily as whatever read they might have on economic conditions, fiscal conditions, et cetera. Some of the other metals that you named seem much more tied to an upcycle in the economy.
Absolutely. I think that there is debasement happening. And with the increase in the monetary base, that is one of the reasons why we have always liked gold, is that the inflation in the monetary base was going to eventually make its way not just into stocks, not just into bonds, but into other areas of the market, including gold. And so our thesis is that it's not just going to be gold that benefits, but platinum and palladium, which are also precious metals. And we have big positions there. Impala and Voltaire are some of our 2 largest positions in the fund, but also areas like copper and nickel and iron ore as well. Commodities historically have passed along a lot of the inflation.
And it's always interesting to me, sort of the relationship that you've seen between the metal itself, gold in this scenario, and some of the gold equities, so to speak. You think about gold miners, for example, for a long time over the past 5 years, you had gold itself outperforming gold miners. That has caught up this year. You've seen a huge rally in the miners themselves. And I wonder how you think about that relationship and how it's changed just in the past year or so.
I think after, the gold miners have been until this year, and really the last couple of years they've rallied, but for a long time they were in a very, very prolonged bear market, and you had investors who liked gold that still would not buy the gold miners. They said they were too risky, that you couldn't buy, and even if you did buy gold miners, you could only buy them in the US and Canada because the geopolitical risk was too high. So there were a lot of times when investors were just not willing at all to look at the gold miners. And now, today, the story has shifted quite significantly. Now the narrative is the gold price is up and I want leverage to the gold price rising. So now people are forgetting about the other risks with mining, and we try to keep an even keel, which is one of the reasons why we are decreasing our gold mining exposure. But those mining risks are very real. CapEx is a very big risk. Right. Geopolitical risks are real. So you have to have big margins of safety when you buy any miner. That includes platinum, that includes copper.
Right. I was going to ask, I mean, you move away from gold miners and you think about miners in general, when it comes to other metals, does that logic apply, or is there any specific commodity where you think that the miners actually really shine?
I think over time, and you have to have a very long horizon, the mining companies should outperform. They should have leverage to whatever commodity they have. That's just the nature of the business. But that also goes to the downside as well. So it really, you need to make sure that you know what price you think the commodity should be at. And what we use are long-term incentive prices. Gold is a little bit different. Platinum is a little bit different because the stock to flow ratio is very high. So you could increase some supply and, it doesn't really matter. There's a huge amount of supply already out there. So it's a little bit different with the precious metals, but with commodities, you really have to have an idea of where the incentive price is. And right now, we think that copper, for example, is close to the incentive price, but the mining companies are not pricing that in.
Alissa, real quickly, only about a minute left. I'm curious if you're seeing any opportunities right now outside of the commodity space.
Absolutely. We're investing in UK financials. Asset managers are very cheap there. Also, international conglomerates. A lot of people find them too complicated. The accounting is complicated. The ownership structures are complicated. And so for those willing to do the work, you can buy these world-class businesses for a third of book value and 6 times earnings and 5% dividend yield. So there's a lot of opportunities. It's just, you have to look, in places where most people don't.
All right, Alissa, got to leave it there. Great to get some time with you. That is Alissa Corcoran. She is co-CIO over at Kopernik Global Investors. Now, coming up, about 15 minutes to go, we'll take you to the closing bell with Margaret Patel. She is head of capital allocation at Allspring Global Investments. This is The Close on Bloomberg.
From Wall Street, we go to Washington. The President of the United States speaking at the White House right now about steps that he wants to take in order to lower the cost of fertility treatments. Let's take a listen.
They sell in the United States, including the most popular drug of all, the IVF drug, Gonal-F. So it's Gonal-F. Is that a proper pronunciation? Close enough, right? Gonal-F. As part of this agreement, EMD Serono will list their fertility drugs online at trumprx.gov at very, very heavily reduced prices that you won't even believe. And ultimately, that's because of the favored nations. In addition, the FDA will be working with the company to expedite review and approval of another common fertility IVF drug, and currently it's selling in Europe. It's Pergoveris. And that's a sound nice name. Pergoveris. Why can't you name them nice, simple names? Nice, easy names. Doesn't matter. If it works, that's all we care about, right? Upon approval, this drug would directly compete against a much more expensive option that currently has a monopoly in the American market, and this will bring down costs very significantly. And the other one's going to have to come down also. Finally, EMD Serono has agreed that all future drugs and everything that it develops and sells in the United States will be offset at most favored nation prices. I've been after this for a long time. And we started the process in the last administration, and then we had a little thing called COVID that came up. We had to focus on that, did a good job on that, too. And they'll bring a significant portion of their drug manufacturing back to the United States. So they're going to bring it largely back into the United States, and that's for a lot of reasons, but primarily because of the election result, November 5th, and maybe most importantly because of the tariffs, because if they do it here, there are no tariffs. So we're going to be very close, I think, by the end of this year. We're going to be very close to $20 trillion in investment. As an example, the Biden administration had less than $1 trillion, substantially less than $1 trillion for 4 years, Maria. Can you imagine? 4 years, less than one. We're going to break $20 trillion of investment, and we're already over $17 trillion, and that's in 8 months. Can you believe that? And he was at less than $1 trillion. And in addition to that, he had open borders, allowing millions of people to pour in. What an administration that was. Worst president in history, by far. As a result of these actions, the per-cycle cost of drugs used in IVF will fall by an estimated 73% for American consumers, and the numbers are going to actually be very substantially higher as time goes by when it really kicks in. For most of, I mean, think of those numbers. You know, I told the story last time because we were with Pfizer, and Pfizer's doing something very similar. But I told them that my first term, I was so proud of myself because I was the first president in 28 years where drug prices went down for the year. And you know what they went down? 1/8 of 1%. But I was so 1/8 of 1%. Now I'm getting them down, Maria, 500, 600, 800%. In some cases, even more than that. It's hard to believe. But I was proud. I said, oh, wow, I'm the first one. 1/8 of 1%. And I was proud of that. Now I realize. And I called a news conference. Some of you were at that news conference, actually. And I said, ladies and gentlemen, congratulations. We've gone down by 1/8 of 1%. And now we're going down 500, 600, 700, 800%, Richard. So it's really something. For most administrations and all of the people involved in this kind of thing, this action would be a crowning achievement of their agenda for fertility health. But for us, it's really just the beginning. It's just the start. It's one of many things we're doing. Today, we're also taking historic steps to vastly expand access to insurance coverage for fertility care, including IVF, something that, as you know, was not covered. Effective immediately, for the first time ever, we will make it legal for companies to offer supplemental insurance plans specifically for fertility. That's never been done before. We're signing it in today with what we sign. Americans will be able to opt in to specialized coverage just as they get vision and dental insurance. They're going to get fertility insurance for the first time. So I don't know. I don't know how well these things are covered. I see the Democrats like to take credit for all of the things we do. We do the things and they take the credit. But I figure if you do enough of these, eventually people are going to figure it out. The Democrats have done nothing. This will make all fertility care, including IVF, far more affordable and accessible. And by providing coverage at every step of the way, it will reduce the number of people who ultimately need to resort to IVF because couples will be able to identify and address problems early. The result will be healthier pregnancies, healthier babies, and many more beautiful American children. It's a big factor. It's a big deal. I'm asking all employers to make these new fertility benefit options available to their employees immediately. The initiatives I've just announced are the boldest and most significant actions ever taken by any president to bring the miracle of life into more American homes.
The President of the United States speaking in Washington right now, new steps that he's taking that he says could lower the cost of fertility treatments. We'll keep an eye on what the president has to say. You can type live go on your Bloomberg terminal to continue seeing that press conference. We should point out that none of the major companies that he's mentioned really moving right now. Merck, obviously potentially the biggest beneficiary of this. Those shares, those ADRs slightly lower here. as we move closer to the closing bells, which are just about 3.5 minutes away. Let's bring in Margaret Patel, head of capital allocation at Allspring Global Investments. And Margaret, this has been a day where I think people are a little bit more focused right now on what's been going on in the financial space, particularly with some of the disclosures that we've gotten with regards to some investments made by some of the regional banks. No real systemic pain just yet, but definitely a market on edge given the record highs that we've been at for the last few weeks.
Well, yes, that's true. But I think what's important is these are really one-off at a couple regional banks. There isn't any underlying theme. It isn't like during the subprime crisis we had in 2009 or during the internet bubble in 2000, where it reflected a systemic problem in the banking system. Also, we're at a time where the Fed is stable to lowering rates as opposed to raising rates. So I think it's just one of those things. Every bank has loan losses, no matter how good they are. This is really just one of those things that affect these banks and doesn't really say anything about the banking system in general or loans in general.
What does it say, if at all, about just the state of the economy, particularly when we get beyond just sort of the big behemoth companies in the public market, those middle market companies, the ones that are supposed to be the sweet spot, if you will, for economic growth?
Yeah. Well, I think what it really reflects is despite what the Fed does in interest rates, there seems to be a tremendous amount of liquidity out there. One, you can see by the fact that loans have been really made so widely. And as we can see, some of them didn't have the best due diligence. So it says there's lots of liquidity. There's a huge demand to buy loan products, as well as you can see, obviously, in equity. The private market for debt and equity is very, very strong. And we can see that inflation is rather stubborn, which says to me that companies have pricing power, so their margins really aren't in any danger. That was one of the things people have been worried about, is that as we had inflation, we'd see margins come under pressure. Really hasn't been the case. So it says to me the economy is chugging along 2 or 3%, and companies are maintaining their profit margins, maintaining growth, especially in those sectors where we're seeing secular growth for a number of years. So we think that puts the market in a very good position to surprise on the upside over the rest of the year and have a strong finish.
Margaret, I do want to go back to the financials because that is the story in markets of today. And I hear what you're saying, that these issues aren't necessarily connected. They seem to be idiosyncratic and one-off, but still there's this overarching fear that perhaps some of these banks hadn't been doing proper due diligence, that competition was so fierce, the pressure to put money to work was so fierce that maybe some standard slip here, and maybe that explains why you're seeing this bleed into what's going on with the big banks today. I mean, what do you make of those concerns specifically?
Well, again, that's really a reflection of the tremendous amount of liquidity that perhaps some lenders were too aggressive in wanting to make loans rather than doing the much more conservative due diligence they would have done if we had credit conditions tightening up. So I think it's just one side of this. There's liquidity sloshing all around the world for all kinds of assets. And again, the banking system has much more restraints on it than when we had previous crises. So we think it's just one of those little bumps in the road, doesn't reflect on the economy, or certainly not on the large banks that are run pretty conservatively right now.
All right, Margaret Patel, head of capital allocation over at Allspring Global. As we get the closing bells here in New York, it is red across the screen, though we should point out we did start the day in the green, but some concerns here about the state of the regional banking sector, whether some of the issues that we're seeing right now when it comes to Western Alliance are indeed just problems for Western Alliance or is something a little broader. The Dow down more than 300 points or 0.6%. The S&P down 42 points or 0.6%. The NASDAQ down about 100 points or 0.5% on the day. But the biggest decliner here on the day, at least as far as the major indices, that is the Russell 2000, which of course is populated with a lot of those small and regional banks. That finished lower by 53 points or 2.1%.
Absolutely. And to your point about, whether investors are concerned that this is something bigger, I mean, taking a look at the circle, that certainly seems to be the case. Look at the one slice of green here, tech, up just marginally here, about 0.1% or so. The rest is all red, led by the financials, as you say. Of course, that is your biggest loser on the day. And amazingly, it's not just the regional banks, it's the KBW Bank Index overall that really bore the brunt of a lot of this selling.
Well, do want to talk about some of the gainers, and we'll get to some of the decliners, which of course are going to be in that space. But we did have a few bright spots today, particularly in the transportation space with a phenomenal day for J.B. Hunt. And we get to this idea of what's the barometer for the economy. When we look to regional banks, we also look to a lot of the transportation and shipping companies here, a 22% pop here on the day. And then you saw Micron, and of course that big tech trade still continue on. And in fact, it wasn't just Micron, but you saw Salesforce after it sort of gave guidance that seemed to encourage a lot of people. Oracle, all of the big players in that AI infrastructure build out, and that includes, of course, the memory chip makers like Micron getting pretty strong bids on the day. Micron up 5.5%. And then Praxis Precision Medicines put there up on the screen, Katie Greifeld, a phenomenal day there, almost tripling in price.
Absolutely. So some good news stories to be found, but let's get back, of course, to what is in the zeitgeist of this market, and that is what is going on with a pair of regional banks. Zions Bancorp down about 13%, Western Alliance down almost 11% on the day. To get specific here, the company said that they were victims of fraud on loans to funds that invest in distressed commercial mortgages. So really fueling concerns that there are more cracks that are going to emerge here. You think about the experience with First Brands and Tricolor last week coming through to this week as well.
Well, that's what I'm curious about. I mean, it's easy to say, okay, we're blaming this on fraud. But of course, I mean, the whole point of being a lender is that you're doing due diligence on these people. And as we found out with First Brands, with some great reporting by Bloomberg as well as Financial Times, it did appear that, at least in that specific situation, maybe there wasn't enough due diligence done on that founder. Now, we don't know exactly what's going on with this particular loan with regards to Western Alliance and Zions, but it does raise the questions as to what was done in advance.
Absolutely, and that is the big worry here, that maybe these are, of course, idiosyncratic issues, as we were just discussing with Margaret Patel, but the overarching worry is that maybe standards had been started to slip a little bit. We know that we're in still a good economy. We know that competition is fierce among these lenders, so that's at least the concern that is playing out in markets on this day.
We do want to get to some earnings crossing the wire right now, and we were just talking about J.B. Hunt. Let's talk a little bit about the railroads here. CSX just out with their earnings just now. Just a second to pull them up here, but the knee-jerk reaction is to the upside in the shares, up about 1% as the company said it reported EPS in the most recent quarter of 37 cents a share. That compares with 46 cents in the year-over-year period. No real comparison here to what analysts are expecting, but revenue did come in line with estimates. $3.59 billion. The street was looking on average for about $3.57 billion. The company is saying that it did get a little bit of a reprieve when it comes to fuel costs, though we should point out operating income at about $1.09 billion, slightly below the average of street estimates.
All right, let me do Romaine's job and get to yields right now. This is exciting. Let's take a look at what happened in the bond market. A real flight to safety today as you saw equities sink in a big way. A lot of demand for the front end of the yield curve. Yields down by 8 basis points when it comes to 2-year treasuries. Perhaps investors thinking that if cracks really do widen in the credit markets, that this Fed is going to have to loosen policy maybe at a faster pace than has been anticipated. But you also saw that haven demand coming into the long end as well. Romaine, 10-year treasury yields now below 4%.
Absolutely here, and we should talk about this idea that everyone now is talking about the health that's been going on in the private markets, how that spills over into the public markets. We're going to have a conversation in just a second with the global head of private capital advisory over at Raymond James. We're also going to go back down to Washington and check in here on the efforts by the Trump administration to lower drug costs, this time specifically when it comes to fertility treatments. A conversation with the FDA Commissioner, Marty McCary. That's coming up after the break. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostick. We take a look at where the markets ended the day, a bit different than where they started the day. Green on the screen at about 9:30 a.m. That flipped into the red after a couple hours into the session. We did finish off the lows of the day. Still some pretty significant declines. Probably the biggest declines, of course, of what you're seeing in the regional bank sector. A 6% drop for the KRX, the KBW Regional Bank Index. And the Russell 2000 also down significantly, 2%, largely because of the outsized weightings that you have with regards to small and regional banks there, a bid coming into some of the safe havens, including gold, 2.6% to another record high.
Let's talk a little bit more specifically about those regional banks. We have our eyes on Zions and Western Alliance. Zions sinking in a big way after it disclosed a $50 million charge-off for a loan underwritten by a wholly owned subsidiary. Then you take a look at Western Alliance, down nearly 11% after it said it made loans to the same borrowers. So really, you can see that fanning fears across the regional banking landscape. And that brings us to our top story, that plunge in the pair of regional banks, really underscoring the fragility of a $28 trillion bull market. The renewed bank volatility coming after the collapse of subprime auto lender Tricolor Holdings hit giant JP Morgan, prompting Jamie Dimon to warn, quote, "When you see one cockroach, there are probably more," a quip that some of his non-bank rivals have taken as a shot against them. Blue Owl CEO Mark Lipschultz firing back, saying that banks might want to look at their own books for any, quote, cockroaches. Private credit further on the defense after a group of academics at Johns Hopkins and UCal Irvine warning that the industry's claims of market-beating stress-free returns are illusory.
Absolutely, and I was just out at the CASE conference in Los Angeles, and this was the talk of the town. Of course, the comments there by Lipschultz on stage there, raising some big questions about if there are cockroaches. I guess, where are those cockroaches? Sally Bakewell joins us right now, helps to lead our financial coverage. Where are the cockroaches, Sally Bakewell?
Well, there's certainly one in these funds that are run by these two individuals where this fraud has emerged. And these funds were the borrowers of both Western Alliance and Zions. So they're not First Brands and they're not Tricolor, which were the two events the two sort of collapses that happened last month that really spooked the market. But what's interesting here is the idea that these are just isolated events. Well, they're now three in quick succession.
Yeah.
So I think that the idea
there used to be an old saying in journalism, 3 makes a trend.
Exactly,
yeah.
exactly.
Okay.
And so this trio, I think, is sort of spooking investors that these aren't isolated events and that there are broader, they're fueling concerns that these cracks run a little bit deeper.
And this is impossible for you to know, so I won't ask you this directly, but I do wonder if the reaction that we saw in the regional banking sector would have been as dramatic as we saw today had we not just gone through First Brands and Tricolor. But you really articulate the concern out there that, okay, maybe these are non-connected events. There's not going to be necessarily a daisy chain here, but you are starting to see more of these cockroaches crop up at a similar time, and maybe even if they're idiosyncratic, that it does speak to something broader going on, which is banks sort of letting their standards slip here.
Right, exactly. If you have 100 isolated events, you have a broader problem.
Right.
And I think this is what the sort of barbs that were traded between Jamie Dimon and sort of private credit firms. Is there a level of due diligence that is slipping here amid borrowing markets that are slightly wide open, and we're starting to see sort of later cycle behavior and little bits of froth, and is that sort of indicating a broader problem? And what's interesting is that when it's a big bank like JP Morgan, which actually took a 170 million hit on Tricolor Holdings, the subprime water lender that collapsed last month, that doesn't matter. But when it's a smaller bank like a Zions or a Western Alliance, that is when it's a bit more concerning, and I think that's what the broader sector is responding to as well. Smaller banks, it's more of a worry.
Sally Bakewell helps to lead our financial coverage here at Bloomberg. We keep the conversation going right now with the global head of private capital advisory over at Raymond James, Sunaina Sinha. And Sunaina, this gets to this question now as to whether these three events are indeed just isolated events, a lapse in judgment or lapse in due diligence, or whether we should be looking for something that's a little broader and maybe even potentially more systemic.
I think you've got to look at the type of lender here and make that differentiation between bank lending and what are the standards there. And is there a standards issue? I think that's a very valid question. Is there a slippage in diligence? What are the criteria for lending at banks? And then what's happening in the private credit industry? There is no such thing as zero loss ratio in any type of investing, whether it's equity or it's debt. So let's just start with that. There are going to be losses. The question is, how much, and is it going to become systemic in terms of risk or not? What I can say for the private credit industry is that the loss ratios better be meaningfully low, or there's existential risk at the firm level. And these owners of BDC, asset owners of BDC, know that very well. And so they're looking through their books right now to see where are the holes, where are the weaknesses, and are they marked appropriately so investors have fair warning as to what the credit is worth?
I mean, obviously, one of the biggest criticisms over the years about private capital, at least from an investor perspective, was the lack of transparency, that you're basically trusting these asset managers to tell you what is what, more or less. Given that you do have publicly traded BDCs and some sort of insight into what's going on, and you look at the valuation gap between those publicly traded vehicles and maybe what we're seeing on the private side, what is that telling you?
Well, I think it's telling you a couple of different things. Firstly, on the private side, there is a lag to when the marks are reported, and also just how the marks are valued. Each sponsor will have its own valuation policy. Now, these are usually very robust, or investors, especially institutional investors, don't put their capital behind them. And then secondly, these are audited each year. So let's state that up front. However, that valuation policy matters, and where and how they take the write-downs if their loans are going bad, and or take the losses if we're looking at write-offs, really does come into account.
Well, I'm going to ask you the same question, but in a different way. And this is more from the LP perspective, and maybe even to that extent, the GPs. When you're talking about maybe going out, say tomorrow, and trying to start a new fundraise, with this hanging over there, even if it's not directly related to the firm that you might be investing in, do you think that's going to curtail fundraising even more so than it already has been this year?
Well, fundraising for buyouts and growth and venture strategies have been incredibly impacted. We've talked about this before, Romain. That market has been slower than anyone would like and want for the last 2.5 years. Hopefully turning new soon, seeing some green shoots, but that's the case. Private credit has been through a boom cycle, right? If you think at all the big large caps out there, their big growth strategies has been private credit, has been direct lending, BDCs are growing. That's where LPs are leaning in, because they often come in interval fund, semi-liquid structures. They can get liquidity sooner. There's a yield play there. So that fundraising market has been very healthy for the last 3 to 5 years, and so far continues to remain so because of the nature of the paper that they're investing in.
Well, to that point, let's talk about another bucket of cold water that might have been poured on private credit, and that comes from the Journal of Private Markets Investing. And basically, the academics there were looking at the returns that you get in private credit and looking at that versus leveraged loans. And they concluded that private credit performance is both lacking in alpha as well as a timely return of capital. So you talked a little bit about, whether these securities are being marked correctly. But I mean, what do you make of that argument, which comes at a very sensitive time for the industry?
It sure does. But when you look at the beta of any asset class, it's mediocre. If you look at the beta of private equity at large, it will be middling. If you look at the overall returns of most asset classes and are taking the entire market into consideration, that data is going to be spurious. The investors, institutional investors that back these private credit firms, they're in the alpha hunting mode. So you've got to select. It's security selection, but at the fund level. If you do that well, you will have outperformance, and you do in some of the best private credit managers out there. You do have that outperformance, but if you're going to go buy the market at large, then you are going to get performance that's probably about the same as buying debt paper elsewhere, like in the leveraged loan market.
And of course, you and Romain were discussing fundraising, what effect, whether or not this will have a chilling effect on fundraising. But I want to situate this conversation in what we're seeing in terms of the push to open up access to retail investors as well to private markets writ large, but also specifically to private credit. We've seen a few vehicles launch in the ETF space, for example, that offer that exposure. And I wonder if this will have any impact on sort of the appetite among retail investors and also issuers, frankly, to give that exposure.
Absolutely. The retail move into private markets, especially private credit and private equity, that's occurred already. Now we're looking at $50–60 billion worth of flow a quarter from retail into private market vehicles. That market's been cast wide open. If you look at Blackstone, for example, most of its inflows come from the retail channel. They're on almost all major platforms with all of their major funds. I think what's interesting from what you say is that now access is being opened up to 401k. And how that's structured, what percentage of portfolio allocations go into private markets, and in what liquidity structure becomes incredibly important in the context of this discussion. Because if there are big accidents and it's impacting retirement portfolios, that will come with its issues. Now, it's being done very carefully and thoughtfully. That market has not, floodgates have not opened, and it's being structured through these semi-liquid vehicles where liquidity can be gotten if you need it.
But with that structure, I am curious, what does that mean for the traditional GP, LP, the institutional relationships that have been the hallmark and has been strained to a certain extent because of the lack of exits or the lack of liquidity that the LPs felt they should have had? Does bringing in retail and bringing in a new semi-liquid structure for them, does that effectively kind of dilute the power that the institutions would have?
And that's what a lot of institutions are complaining about.
Yeah.
The CIs of major public pension plans have gone out on record saying, how does this work vis-a-vis institutional capital that's being provided? The market in private equity and private credit has bifurcated. Institutional LPs on one side and private market participants through the retail channels on the other side. And there are questions like, do the funds invest in deals pari passu across the vehicles that have closed-end drawdown traditional GPLP structures and semi-liquid interfund-like structures, because they have different durations, they have different costs of capital. In the secondaries market, for example, we're seeing the asset owners who have semi-liquid products able to bid higher because they have a different cost of capital and different duration considerations. They can be more aggressive versus those with closed-end structures. So the market is fundamentally changing in its tenor, for sure.
Sunaina, unfortunately, we have to leave it there. Really enjoyed this conversation. Come back soon. That is Sunaina Sinha. She is Global Head of Private Capital Advisory over at Raymond James. Now, coming up later this hour, a discussion on the latest announcement out of the White House. We'll have that with Dr. Marty Makary, Commissioner of the Food and Drug Administration. This is The Close on Bloomberg. Well, Bloomberg is hosting the Enterprise Tech and Data Summit today. The keynote conversation happening right now. Let's catch some of the highlights from Citadel's CTO speaking with our own Danny Berger.
Nonetheless, and we've used that to make alpha, right? But in the discretionary space, which is what people are talking about right now when we have AI tools, I think it is a tool that will improve productivity for sure.
Well, it can also lower the cost in some of that productivity, too, in some areas. And this kind of goes to one of the audience questions we have that we were talking about. Can smaller hedge funds compete? You said there's space for them. Is there potentially more space even for them now, powered with AI, maybe not to generate alpha, but to increase productivity and maybe to lower costs or lower the necessary amount of staff that they might need?
So I think if I think about AI as a tool, it's an important tool. It is a force multiplier, not a leveler. Right? So it really depends on how the people who are using it. If somebody small is able to use it better, that's a different story. But in of itself, I don't think it is the reason why smaller players are going to compete better because they have the advantage of AI, because everybody has the advantage of AI. It is the people who cannot adapt to use it the right way that will fail, or people who think they are using it the right way but use it exactly the wrong way, which is interesting to see, because if you offload judgment that a person needs to have to an AI machine, that's one good way to lose money.
Are you seeing that happen? Is that a common route?
I'm not saying that it happens. We have to make sure that it doesn't, right? So it's a very slippery slope, because I think when people say AI, they latch onto the intelligence word, and then they quickly slide into the judgment territory, right? That is a slippery slope.
Could it change, though? Is it definitive that you can't get any source of alpha from it? Could you see a future or changes to the technology itself where that does become a possibility? Can you write off that for the future?
All I'm saying is AI today, it doesn't help me predict the future. It helps me see the present more clearly. That's all I can say right now, right? If anything were to change, I will make the statement based on what it is then, but as I see it right here, right now, and the trajectory that I see it in the near future, it's going to make me see the present more. It's going to help me, not make me, help me see the present more clearly. And it is an important tool, but it is one tool in the toolbox.
Is it changing how the importance of that tool? Has that changed as more advancements have been made in generative AI?
Of course, yeah. I mean, 3 years ago, we were not talking about this.
Of course.
Right? Especially for engineers, we're seeing in some places again, we are seeing productivity boost in coding and testing and the like. So we are seeing it making changes, but like you said before, it is increasing productivity.
Right. I mean, there have always been points in the past, especially with LLMs and honestly, just in quantitative hedge funds in general, of this idea of p-hacking, of overfitting, where you have a back test where things look great. Does the temptation to do that increase even more when powered with AI? Are mistakes more likely where you torture data to make it look right?
In the market, there probably is. At Citadel, there's a clear culture that makes sure that that doesn't creep in.
Talk more about that. How do you make sure that doesn't creep in?
I mean, we have to stay vigilant in all tools. When we set standards, when we think about what is appropriate for use for where, there's a clear depth of leadership focus on making sure that the best-in-class research is preserved, right? And then there's a culture to make sure that that is not just preserved in words, it's preserved in software. That's my job, right? To make sure the best practices of how things are supposed to be done has to be made easy in software. That is, at the end of the day, if you really think about how that process makes its way into the software, that is the beginnings of the building of like a competitive advantage for your firm, right? And if you don't think about that and build another piece of software, you might think that it is a force multiplier, but it might be a competitive disadvantage.
I remember you said in Milken that Ken Griffin uses ChatGPT.
I think I was asked that question, yes, and I answered it.
Do you use ChatGPT?
I do use ChatGPT.
How do you use it?
Oh my God! In my life, in personal life, yeah.
Sure, life, work. Are the folks at Citadel allowed to be using ChatGPT on work computers? Is it blocked?
Okay, so remember you and I were talking about the problem that I have in my foot outside.
Yes, yeah.
I took a picture of the thing and then asked ChatGPT what it is, and it was like, yeah, it was pretty darn close to what exactly.
Subramanian, Citadel CTO, speaking right now with Danny Berger. This is at Bloomberg's Enterprise Tech and Data Summit. You can continue looking at that conversation as well as the other conversations going on at that summit by typing in LiveGo on your Bloomberg terminal. All right, meanwhile, Katie, let's get back to markets here. A down day pretty much across the board.
Yeah, absolutely. Of course, a lot of that coming out of the regional banking sector and the stresses there, which we'll continue to monitor. But coming up on the close, I'm pleased to say we'll be joined by former Coach CEO Lew Frankfort. He's in the house to discuss his new book and how he took the brand from a $5 million leather goods shop to a $6 billion powerhouse. That conversation up next. This is The Close on Bloomberg.
All right, LVMH's return to growth is putting the luxury market back in focus as investors grasp for any kind of read on consumer spending amid the shutdown here in the U.S. Our next guest is out with a new book about pioneering the concept of accessible luxury when he hit the ground running as the CEO of Coach, turning a company that was, well, selling a few $1 million worth of goods into one that was selling a few $1 billion worth of goods. Pleased to say that Lew Frankfort joins us right now, the chairman emeritus over at Coach Brand and the author of the new book, Bagman, the story behind the improbable rise of Coach. Great to have you here. And kudos to whoever came up with that title. Was that you or was that your editor?
I think it was.
All right. Well, I mean, it's fitting because when you think about the evolution of what Coach, or what we know Coach to be, you kind of forget. It started out very small. It was a local here in New York, relatively niche brand, wallets, other small leather goods. How do you take something like that and think to yourself, I can make this into something that is for everybody?
I think you need to start with belief in possibilities. You need to have imagination. You need to have immersive curiosity. And you need to really focus on the women and men that are buying the product. And even before I started at Coach, while it was very small, it had a very devoted following, and some people even felt it had a cult following, and that intrigued me.
When you started to look at the customer base, I read that you spent a lot of time trying to figure out sort of what they wanted, trying to create, I don't know if data is the right phrase to use, but the idea of trying to be a little bit more systematic in assessing who the consumer is and what they want. How did you do that in the 1980s? Relative to today where you have much more access to data?
From the very beginning, we interviewed consumers in stores. At our factory, we did quantitative research, and we combined that with understanding where they would want to shop. So through today, the leadership is focusing on where did consumers shop yesterday, where did they shop today, and where will they shop 3 years from now, and what do they want to buy. And from the very beginning, I was focused on giving consumers the opportunity to purchase products in whatever channel they wanted. And we opened a catalog. We were a wholesale business when I started. Yeah. Within the first year, we opened a consumer catalog. And then a few months later, we opened the first Coach store, a small store on Madison Avenue. In the first 12 months, it did over $1 million, which would be.
And when you say that was small store, I mean, we're talking like 400 square feet or something.
Exactly.
But not everybody was on board with that. A lot of people thought that you were crazy.
Well, I was told by a colleague, could I get my job back in city government? Because the founder was fickle. Yeah. And what happened in the first few months, we had, during the holiday season, we had lines out the door to the corner. And I wound up having staff give people candies and drinks. And when we had 3 channels, we called ourselves a multi-channel business. Today, they're called omni-channels.
Right.
And again, you need magic and logic. So the logic comes in with having a mindset for the greater good, being value driven. Metrics are really important. Numbers don't lie. And we walked between magic and logic. And today, Todd and Stuart and the team continue to do that.
Todd Kahn, who's now the Coach brand president.
Right, magic and logic. I do love that pairing there. It is interesting. I mean, you think about when you started at Coach, the accessible luxury segment that exists now. That's well established. You, of course, were one of the pioneers of it. And I wonder just about the genesis of that. When you think, of course, not just about channels, but price points, how did you identify that as really an area for growth?
That's a great question. And in fact, we coined the term accessible luxury before we went public in the year 2000, when it was still a single lane, but we thought it could turn into a superhighway if we continue to listen to consumers and be there when they got there with the right product, high customer service levels, and enhanced environments. But again, we're a country of immigrants. And in 1980, there was mass, and there were a small number of small brands, somewhere between mass and luxury. And luxury at the time, the European brands only had a small number of stores in major cities, but we had a growing middle class, and women really valued their bags.
Yeah.
And I've always believed in democratized luxury. The concept, that's about America. It's a melting pot. And I wanted to bring a product to market that would appeal to the growing middle class, and we targeted top 20%.
But I am curious, though, too, because around this time that you were doing this, I mean, we talk about LVMH. I mean, Louis Vuitton was a relatively small company at the time, and a brand, I should say.
Yes.
So what was the difference between where Louis Vuitton went and where Coach went?
Well, I studied Louis Vuitton and admired them from the beginning, and still do, of course. They make a great product, and the service levels are very high. What attracted me about LV is that they control their destiny. They only sell at the time, they only sold in their own stores. And when I joined, we only sold in wholesale. So I had a vision that if we could open our own stores, staff it with knowledgeable, empathic people who would provide good service, we would be able to build a business that would really effectively be a lane in the middle. And that's what we did. And the team continues to do that.
And I have to imagine that was an area where magic plus logic comes in, because the logic is there. Women value handbags, and you want to democratize the access there. And this isn't just for handbags, too. You think about brands across categories, across industries. Once you go down in price, it's easy to sort of degrade the value of your brand. So, I mean, how do you protect against that? And when you take a look across industries right now where that has happened, you discount and then maybe you lose some of your value and your magic there. I mean, how do you guard against that, basically?
Well, in several ways. First, intrinsically, the product you're offering has to represent good value. So from the very beginning, we offered product made out of natural leather that actually burnished, got better over time. We priced it in a very accessible way. And during tough times, you need to manage inventory, anticipate that, so you're not in a situation where you have too much inventory. You also have to find other ways to dispose of excess product, and there were always opportunities to do that. But going on sale to reduce inventory broadly is something that can stay in people's minds, and I caution everyone not to do that if they can avoid it.
We talk about the growth of Coach from a multi-million-dollar business to a multi-billion-dollar business, but of course that's not in a straight line, never is for any company, particularly in the retail and apparel space. I'm sure you're aware of the resurgence that we've seen in interest for the Coach brand, particularly amongst younger consumers right now. What do you make of it? I mean, particularly not only the job that Todd is doing as Coach brand CEO and Joanne as head of Tapestry, but also just the idea that it's back in the zeitgeist. Sort of what drove that, and how do you maintain that going forward?
They are in the sweet spot. Coach is in the sweet spot. I'm thrilled that it's going through maybe its fifth renaissance. I transformed the business multiple times, and you need to keep your eye on the consumer. And Gen Z today may only represent 15 or 20% of spend and accessories, but in 10 years it will represent 40%. And people who follow Gen Z's lead, and Gen Z, as you well know, they're into authenticity, they're into sustainability. It's really in many ways back to the future by reinterpreting who we were. We have product like the Brooklyn bag today that is a 21st century version of bags we had in the 1960s and 70s.
Where does growth come, though, from in the luxury industry? This has been a big issue with the European brands, the idea that they're kind of tapped out, that basically anybody who wants a Louis bag or a Gucci purse or whatever probably already has one. With Coach, and I know it's a slightly different category, do you worry at all that there might be sort of a cap to just where you can grow and how much you can grow?
The short answer is you worry about everything, but however you try to put it in some form of perspective. So there are 25 million births each year in markets where Coach thrives today, and those are target consumers. There's second world countries such as China with an incredibly burgeoning middle class, and Coach, we tapped into it 25 years ago, and Coach has over 300 locations, and the business is growing more. You also innovate, and under Todd Kahn's leadership, recently Coach introduced coffee shops, Coach coffee shops next to Coach stores, and that really builds community because you spend 30 or 40 minutes in a store, and then you go next door and you look at everyone's bags. Most people are carrying Coach. They're part of the same community. The coffee shops are profitable, I'm told, and sales in the stores have grown on a like-for-like basis significantly because of the extra time people are spending. So that you need to reach consumers wherever they are, and young people are looking to shop immediately, and they're much more channel agnostic, whether it's TikTok, YouTube, wherever they go, they would like, you need to be there when they get there. And I think innovation, curiosity, thoroughness, recognizing that you need to always run scared, no matter how well you're doing, is critical. Complacency has no place at Coach, and I recommend any company, you cannot be complacent.
Always run scared. That is certainly what I do. I do want to talk a little bit about some of the other brands that you're involved with as well. You're the co-founder and CEO of the Benvolio Group, have been since 2014. When you take a look at where the opportunity set is right now, what are some of the brands that really stick out to you as they're doing it right?
Brands that we invested in?
Certainly.
Sure. Well, a current brand is Veronica Beard, and they are, as you know, they're a contemporary women's brand, and We invested at the very beginning, shortly after they went to market, and we're very active with the Veronicas, and they have done a fabulous job in building a loyal consumer franchise.
Yeah.
It's anchored in jackets. One of the things that attracted us is that women's jackets is the third most loyal category. Intimate apparel first, bags second, and jackets third. And even through today, 35% of their sales are jackets. And that anchors the brand. And you want imagery that works. And they are very consumer-focused, brand-focused, they are product-focused.
Yeah. Well, it's funny to hear you say that. I mean, a good blazer is hard to find, especially as a woman. So certainly see the appeal there. Lew, have to leave it there. So enjoyed this time with you. Thank you for that. That is Coach Chairman Emeritus, and former CEO Lew Frankfort. He's the author of the new book, Bagman, the story behind the improbable rise of Coach. Now, coming up, the Fed's Christopher Waller calling for careful cuts while Stephen Myron advocates for a bigger move. We'll discuss with Nathan Sheets. He's a global chief economist over at Citi Research. Next. This is The Close on Bloomberg.
So the way to avoid that is to go, cautiously or carefully and do 25, wait and see what happens, and then you can get a better idea of what to do.
Christopher Waller, Fed governor there, speaking a little bit earlier on Bloomberg Television, the idea of caution, rate cuts in increments, he says, to support a faltering labor market. This comes as the other Fed governor, Stephen Myron, continues to call for a much larger and swifter reduction in rates. Global chief economist over at Citi Research joins us right now, Nathan Sheets. And to get your take here, Nathan, we get this idea of caution, and I don't know why anyone would sort of question that, but I guess my question for you is why is that caution needed?
I think the Fed is at a place where it's having to choose in some sense between its key mandates. On the one hand, as Governor Waller indicated, the labor market is softening. But on the other hand, inflation is not at 2%. Indeed, it's closer to 3%, and it's likely to rise a little bit more. So I think they have weighed the pros and cons and the risks associated with each of these legs of their mandate and have come to the conclusion that the risks on the employment side are more severe. But this is a very complex and balanced judgment. And caution has to be the description of the strategy from here. Meeting by meeting, data intensive to the extent that you can get data, and careful.
Yeah, and I'm glad you bring that out. I mean, you're sitting in Washington right now, which at least as far as Capitol Hill goes, has been a bit of a ghost town. And I do wonder, sort of as we get a little bit closer to the Fed's meeting at the end of this month, what are they going to be relying on to make an informed decision?
It's tricky. Hopefully, we'll get a CPI report. That's been signaled. But from there, candidly, you're looking at indicators that historically have not been very reliable. And maybe another source of information that could be helpful to them is the earnings reports from the corporate sector for the third quarter. That are coming out during the third quarter. And putting all that together, it's going to be noticeable in the Fed's analysis that they don't have the full slate of data that they usually rely on. And again, it underscores this word caution and the need to be careful here.
That's really interesting to hear that, perhaps it's corporate America that might sort of plug the gap left behind by official government data on the economy while we're still in this shutdown, Nathan. In normal times, when the government is open, when we're getting data on schedule, I mean, how does the FOMC, how do policymakers typically weight what we see on the earnings front when they're making their decisions?
I think that broadly speaking, the Fed pays attention to those earnings reports and what the corporates are saying. And a fair amount of that gets incorporated into their beige book that comes out before each meeting. But it's of secondary importance. But I think the lack of the published data, but also the reality that we're trying to better understand tariff pass-through. And a lot of that has to do with the behavior of the corporate sector. And both of these factors, I think, are raising the importance of the earnings calls and the analyses and descriptions from the corporate sector for this meeting.
And it's interesting. I mean, we talk about corporate America, and I want to bring up what's going on, of course, in the regional banking sector right now, because the stress that you saw in the market today, really concerns about cracks emerging in the credit markets. Maybe things have gotten a little frothy and sort of due diligence standards slipped. You did see the 2-year Treasury yield hit its lowest level since 2022. Maybe some investors making the bet that this could push the Fed to cut a little bit more aggressively than they might have otherwise. Some people raising comparisons to what we saw with Silicon Valley Bank. I wonder, in your view, whether or not this could have a material impact on the economy if we see more issues such as the ones that we saw disclosed today arise.
Well, as you say, I think the markets are kicking the tires on credit quality and thinking hard about a variety of exposures and have they been adequately priced and collateralized and so forth. I would be cautiously optimistic, broadly speaking, about credit quality, but could there be some pockets of mispricing in various places in the market? And I think the answer to that is very, very possibly. Now, for the implications for the Federal Reserve, I think the Fed is very worried about issues related to credit quality, the implications for ongoing credit growth in the economy, for the monetary policy transmission mechanism. These are issues that the Fed watches very closely in thinking about both how should it set its rate and how is a given stance of policy influencing the economy.
All right, Nathan, always appreciate it. Great insights. Nathan Sheets, Global Chief Economist over at Citi Research. And of course, a lot of people really focus in right now, Katie, on whether any of these issues potentially becomes systemic. At least for right now, not a lot of people seem concerned that it will.
Absolutely, yeah. We keep hearing, of course, that these are idiosyncratic issues. They're one-off. But as we heard from Sally Bakewell, I mean, if you see 100 of them crop up, maybe they're not connected, but they do say something about the broader environment. So certainly the antenna is up when it comes to this market. Absolutely. Here, and as we wrap up our coverage here on this Thursday, we're going to push ahead when we come back after the break and set you up for what to watch over the next 24 hours. This is Bloomberg. All right, let's push ahead to what the markets are going to have their eyes on over the next 24 hours. Earnings, including out of American Express. Yeah, looking forward to that. Also, Fifth Third Bancorp and Ally Financial. A lot of focus on the financial sectors. Well, particularly with those two. I mean, Fifth Third in the regional space and Ally, of course, a big in the automotive sector. So a lot to look forward to there. We'll also get some Fed speak, specifically from Salem, ahead of the Fed's blackout period. We are counting down to that Fed meeting on October 29th. Can't wait for that blackout period. Meanwhile, the IMF and World Bank meetings are set to wrap up, and we're expecting maybe potentially some announcements on the geopolitical front tomorrow. Absolutely. Ukraine's Zelensky and U.S. President Trump set to meet tomorrow. We'll just have to see how that goes. But I think that does it for us, Romaine. That does it for us. Keep an eye on Balance of Power, which starts at the top of the hour. They're going to have a fuller breakdown of everything going on in Washington and beyond.